Hello everyone, welcome once again with your boy Chrome Investor. So today's video is going to be really interesting, so stick with me. It might be long, but I'm pretty sure it's going to help you if you are new to the stock market and you want to find your way around the stock market. So as the title shows, I'm going to talk to you about individual stock, the difference between individual stocks and in the index fund. I'm going to give you examples. Of course, they differ in terms of returns and in terms of safety. But before getting into that, I'm just going to get something out of the way. It's savings. Savings sucks. I mean, when I grew up, I always my parents, they were always tell me that saving is good, but it's not. I mean, if you're just saving the money just to save it, you're gonna lose the power of that money. Let's take, for example, you have saved $10,000 or 100,000 kroner, Norwegian kroner, in a period of time of 10 years, let's say, just for as an example. The power of that money 10 years ago in 2011 or 2010 is not the same as the power of the money now in 2021 because of inflation. Everything goes up in terms of prices. Homes goes up in terms of prices, food goes up in terms of prices, clothes goes up, everything goes up. And as a consumer, you should protect yourself against these things. So you can't just save your money, put it in the bank account and think that you're gonna be rich in 10 years from now, because you won't. You should always think ahead, think about inflation 10 years from now, how's it gonna be. Let's say, for example, I have a goal of having $1 million or 10 million kroner like 10 years from now. I'm gonna rethink that number, because $1 million, if I want to retire early, that is. So $1 million 10 years from now is not going to be the same as $1 million today. So I'm going to probably aim for higher, maybe probably for double, or maybe at least 1.5 million if I want to retire early 10 years from now. That way I'm protected against inflation, and it's going to be the same as now. $1 million now, 1.5 or $2 million 10 years from now. So you should be always thinking about these kind of things. So now let's get into individual stocks and index funds. Index funds, in terms of safety, are the best there is. Hold on. When I say the best there is, if you are not into the stock markets a lot, if you don't want to do your research, a lot of research, you just pick the S&P 500 or funds that composes of or includes a lot of companies. Let's take, for example, S&P 500. The 500 comes from the companies that is inside that fund. So they track the 500 companies located in the US. That way you make a return over your money on a year-to-year basis, and that return protects you against inflation. Individual stocks, here there is more risk. Why there is more risk? Because you need to research those companies. You need really to be up to date every day on what the company is doing, because if it does bad and it goes bankrupt, you're gonna lose your money. But what you do, you just track that company in the bad and the good, and you kind of evaluate if you want to sell or not, depending on the fundamentals of the company and what they are doing. So that's why it has more risk, but on the other side it has more reward, because individual stocks you could earn a lot of percentage in terms of annual return. I'm telling now 30, 40, 100% return. But when you talk about the index fund or S&P 500, you get an average return of 8% a year. I'm gonna give you an example now. Let's get into my phone. I'm gonna give you an example, so it may be easier to understand. Look here. What is the average annual return of the S&P 500? This is the biggest fund there is in the United States. The S&P 500 index originally began in 1926 as the composite index, comprised of only 90 stocks, according to historical records. The average annual return since its inception in 1926 through to 2018 is approximately 10 to 11%. The annual return since adopting 500 stocks, because they changed from 90 stocks to 500 stocks, that's why S&P 500. The average annual return since adopting 500 stocks into the index in 1957 through 2018 is roughly 8%. So if you have invested from 1957 to 2018, or even now, you're gonna have an annual return of 8%. And do you know that the power of compound interest? 8% this year, and it grows to 8% next year, and another 8%. Your money grows a lot. I'm gonna give you an example now, kind of actual example, to be in track with what we are saying here. This is an app where you kind of put your numbers and you calculate how much you would have earned, or you would maybe potentially earn in the future. Compound interest calculator. It's in the iPhone. It's only in the iPhone, this one, but you're gonna probably find others online. So let's say we're gonna have a starting balance of 1,000. I'm gonna take everything out from here. Let's say you have a starting balance. You are new, you live in Norway, maybe you have a work, you earn maybe 21,000 kroners or $2,000 a month. You have maybe a spouse, husband, wife, girlfriend, boyfriend, it doesn't matter. And you could maybe think maybe of starting investing in the stock market, and you're gonna start investing like 1,000 kroner. You start with the start balance of 1,000 kroner. As we saw in the S&P 500, you get an annual return of 8%. I'm gonna put 8%. Let's take 10 years. You start investing from 2010 or 2011. 10 years. You are periodically adding every month, as you see here, compound addition frequency, month, quarterly, yearly, weekly. You could choose whatever you want. I'm gonna, for this example, go for monthly. You're gonna maybe try to invest $500 or 5,000 kroner. 5,000 kroners, you and your wife, you and your husband, alone maybe, if you are living at your parents, and you have the ability to invest 5,000. You could invest, of course, less, but for this example, we're going 5,000 kroners or $500 a month in a period of 10 years with an annual return of 8%. Let's see here. Investment value 917,000 roughly kroner in 10 years period. You have contributed 600,000 kroner. You have a profit of 316,000 roughly as profit in a period of 10 years. So instead of just putting that money in the bank account and getting 600,000 kroners in 10 years, you're gonna get 917,000 because you invested that money and you got an annual return of 8%. This is the safest thing you could do when it comes to index fund, because index funds, you don't need to do anything. You just like buy the stock, and maybe if it dips, if you someday you find it like going lower, you just buy more and you buy more, and you just forget it. 10 years from now, you're gonna have an annual return of 8% roughly, if not more. It's free money. And of course, I'm not gonna tell you, this is not financial advice, so I'm not telling you what to do. I'm telling you what I would have done if it was me. So this is by no means any financial advice, and we are obliged to say it like that, because even though it's safe, it's still money invested, and money invested, you should always think about maybe it will go to shit. You never know. But as we saw in terms of historical data, that from 1926 they had average return of 10 to 11%, and from 1957, when they included 500 companies in the S&P 500, they have an average return of roughly 8%. Now it brings me to my point. My point is, why do I invest in individual stocks and not index funds? Because I do search a lot on the internet. I do come across different details when it comes to stock market, and I like it. I like going through those details that has to do with companies I own. So it's different from one person to another. If I was lazy and I don't want to do nothing, I would have probably put my money in the S&P 500 and forget about it. But for my case, I take individual stocks because I feel like I can do more and I can earn more. I'm gonna give you an example. I bought one stock because I have short-term stocks and I have long-term stocks. I bought a stock called Nordstrom at $12. 12 or 14, $12. I sold it when it reached $37 or $36. I made 200% on that. You see the difference between making 8% roughly a year and making 200% on a trade? So I bought Nordstrom. I made it I think in a period of time of maybe a couple of months. I bought NEO at $14. I increased a little bit. I had a cost price of $16. I sold it when it reached $60 and around that area. I made 200% return on that as well, plus 12 plus returns. I bought Virgin Galactic when it was $17. I sold it when it was $60 at that range. Sorry. I made 200% return. So you see the difference between individual stocks and index funds? There is a possibility to make more money in individual stocks, but there is more work to put in. So it's not like you're gonna make 200% and that's it. There is some short-term plays that I do where I gain some money from those stocks. And there is my long plays. Long plays means long-term holdings. Some stocks that I would never sell, like for example Tesla, like for example Palantir, like for example Corsair, Tattoo. Those I'm not gonna sell. Those I don't touch. I don't care if they go 200, 300, 400%. Those I'm thinking about long-term, 10 years from now, then we're gonna talk about it. So you see the difference between the things I did. Lately, I just bought Virgin Galactic again when it was at around $25. It went all the way down to almost $15 or $16, $17. I didn't buy more, I just bought 100 shares. I was like, okay, this is short-term play. It took 1 month and 2 weeks to go to $31 and I sold it at $31. I made a return of 23% in a period of 1 month and 2 weeks. This is short-term plays. When I see a stock that is oversold and I feel like there is some catalyst coming that might propel the stock higher, I just buy, but I buy with the money that I'm willing to lose. If it goes to zero, it goes to zero. But I bought 100 shares, I made 23% return. There is other one that I bought 300 shares called Canoe. This one hasn't reached the price target where I'm willing to sell. I'm still down on the stock, but it's fine. I was down on the stock on Virgin Galactic as well when it went to 17, 15, 16. So Canoe, I'm just gonna hold. I have 300 shares. When they go to my target price, which is $11 to $12, I'm gonna sell it again and I have like another good returns in terms of percentage. So the things that you need to bear in mind: individual stocks, more work. Index funds, there is no work or whatsoever. You just buy. You could maybe just track where the stock is, or you could just do it the easiest way, which is DCA. This is the most important thing. DCA, dollar cost average. Dollar cost average means that you have money, you get your money once a month or once a week or whatever. You just take that amount that you are willing to invest, you put it in the stock market. It doesn't matter what is the price, because you can't time the market. You can't wait. No, I'm not gonna buy until it goes down, because you never know if it's gonna go down or if it's gonna just keep on going higher. So that's why the power of DCA, or dollar cost average, is huge. You just put in money. You're gonna buy maybe at 5,000 when it reaches 5,000. You might be buying when it's 3,000 or 2,000. That way you are equilibrating your cost average by dollar cost averaging every month. No one will beat that. So this is why I'm telling you, like, you should always think about the future. Think about what you want to do. My goal is to retire early, spend the time with my family and with my kids or with my daughter. So that's why I'm willing to put the work now into individual stocks. What I'm sharing in this channel is what I'm doing. So if you buy something, it's on you. At the end of the day, it's on you. But if you want to do more work, you could look at other content like mine and look at those stocks, look at the fundamentals when it comes like to balance sheets, what they are doing financially, which I feel like a lot of people are not willing to do that. So if you are not willing to go over the board, just invest safe in index funds and forget about it. That's why some people, what they do, they kind of, people who are not willing to risk their money, what they do is just they put maybe 80-90% of their wealth in index funds, and that remaining 10 or 20 they play with it just a little bit in individual stocks that they like. That way they don't risk nothing, because if they lose that 10% to invest, they still have 80 or 90% pretty much safe. I hope you like this video. I hope it helped you. So think about it. Think about saving when you going out and thinking about buying a coffee or buying something. You should think, oh, of course I'm not telling you that you should enjoy your life. You know, you should enjoy your life at the end of the day, but you should be willing to sacrifice a little bit of your income in terms of building wealth in the future. I hope you liked the video. If you did and you want to find your way back, please consider subscribing down below, and see you on my next video. Bye bye.